Hello, everyone! Today I have brought you a lesson on trading. Before going to the video, please subscribe to the channel quickly. Everyone uses money. We buy goods, obtain services, and send money to others. In the past, people used physical money, that is, coins and banknotes. However, with the advent of technology, the way we use money has changed significantly. One development that has garnered global attention amidst this change is cryptocurrency. Simply put, cryptocurrency is a digital currency that operates on blockchain technology. This is a digital asset that holds value, much like ordinary money. However, the difference is it is not a monetary system controlled by a government or a bank. Cryptocurrency transactions take place via a blockchain network. Cryptocurrencies like Bitcoin and Ethereum are the most well-known examples in the world today.
Now, let's look at the difference between digital money and traditional money. Examples of the conventional money we currently use include Sri Lankan rupees, US dollars, and euros. These are issued by national central banks and governments. For this reason, this monetary system is known as a centralized system. However, cryptocurrency is different. With cryptocurrency, blockchain technology is used. Transactions are verified via a network. There is no single entity in complete control. To take a simple example, in a standard bank transaction, your money moves through a bank. But with cryptocurrency, the transaction is verified through the blockchain network blocker.
Now, a question arises. Why did cryptocurrency become so popular? There are several reasons for this. The first point is decentralization. The fact that many cryptocurrencies are not under the control of a single entity. The second point is global access. The ability to conduct transactions from anywhere in the world via a digital network. The third factor is blockchain technology. It aims to provide a secure and transparent transaction system. Another reason is the rising value of cryptocurrencies like Bitcoin and the attention they are attracting from major investors. However, keep in mind, cryptocurrency is a field that offers opportunities but also carries risks. Therefore, acquiring knowledge first is crucial.
2008 is a very important year in the history of cryptocurrency. The main elements needed are the major economic crisis that the world faced. This economic crisis, which began in America in 2008, quickly affected many countries in the world. At that time, several large banks and financial institutions were in serious crisis. Many people had questions about their own monetary system. People started thinking, do we need our money to be completely dependent on banks and media institutions? What if people could exchange money safely and smoothly without banks? These are the ideas that focused attention on a new normal monetary system. That is, a monetary system based on technology, not controlled by any single institution. The main creation that took that idea forward was Bitcoin.
The person or group that created Bitcoin is known as Satoshi Nakamoto. But to this day, no one knows for sure who Satoshi Nakamoto is. Whether he was an individual or a group of individuals remains a mystery. In October 2008, Satoshi Nakamoto introduced a document called Bitcoin, a peer-to-peer electronic cash system. This is known as the Bitcoin White Paper. This white paper described a way to securely transfer money over a computer network without a bank or central institution. It was a moment that made a big difference in the history of cryptocurrency. The Bitcoin network officially launched in January 2009. The first Bitcoin block is called the Genesis block. This is the first block in the Bitcoin blockchain. Bitcoin was created on a technology called blockchain. The specialty of this is that all transactions are confirmed by a computer network. No one person or institution can control this system.
Another special thing about Bitcoin is its limited supply. The total number of Bitcoins is limited to 21 million. This is a different feature from ordinary money.
After Bitcoin was launched, its first real-world transaction took place in 2010. It was done by a person named Laszlo Hanyecz. He used 10,000 Bitcoin to buy 2 pizzas. Today, this event is a very famous event in the history of cryptocurrency. It is called Bitcoin Pizza Day. Although the value of Bitcoin was very small at the time, the event showed that Bitcoin was a digital currency that could be used in the real world. Since then, the world of Bitcoin and cryptocurrency has grown very rapidly.
Now let's look at the technology that is at the heart of cryptocurrency. That is blockchain. Many people have heard of cryptocurrency, but to understand how cryptocurrency works, you need to understand blockchain. Simply put, blockchain is a digital record book that securely stores transaction records. Let's think of an attendance book in a school. It records who came and who didn't come every day. Blockchain is like that, but the difference is, a single person can have a regular book. Thousands of copies of these records in blockchain are on computers around the world. Therefore, it is difficult for a single person to change that information. Let's look at an example. Imagine you send a Bitcoin to someone else. That transaction is recorded in blockchain. That record is checked and confirmed by many computers in the network. Then it becomes a permanent record.
Now, let's see what a block is in blockchain. As the name suggests, blockchain is made up of blocks. A block is a section that stores transaction information. For example, a block can contain transaction information, date and time, information related to the previous block, a security code. When a certain number of transactions are added to a block, that block is added to the blockchain. Now, let's see how one block is connected to another block. One block is connected to the previous block. That's why the name blockchain is block plus chain. The special thing here is, after a new block is added, if the information in an old block is changed, the entire chain will be affected. Therefore, blockchain is a very secure system. One of the biggest features of blockchain is decentralization. Simply put, not being controlled by a single place. In a normal banking system, the bank controls all the data. But in blockchain, the data is not in one place. It is distributed across a large number of computers around the world. Therefore, even if there is a problem in one place, the network can still function. Computers in a blockchain network are called nodes. A node is a computer that is connected to the blockchain network. The functions of these nodes are verifying transactions, maintaining the blockchain record, protecting the network. A network like Bitcoin has a large number of nodes around the world. Another important thing used for blockchain security is hash. Hash is a special code created from information. It is like a long code of letters and numbers. If any information is changed, the hash also changes. Therefore, it is very difficult to change the data in the blockchain and cheat. Finally, let's look at what mining is. Mining in the Bitcoin network is the process of confirming new transactions. Computers, called miners, perform large calculations and add a new block to the blockchain. For this, they receive a Bitcoin reward. This process allows the Bitcoin network to be maintained securely. Now, let's look at how Bitcoin, the main name in the world of cryptocurrency, works. Bitcoin is not a currency issued by any country like regular money. This operates on a blockchain network. Let's say you want to send a Bitcoin to your friend. You initiate a transaction from your Bitcoin wallet. Here, information goes to the network. That is, this person has some Bitcoin, and he is trying to send some of it to another person. Then the nodes and miners of the Bitcoin network check this transaction. They look, does the sender really have Bitcoin? Is this transaction valid? Has this Bitcoin been used before? If everything is correct, the transaction is added to the blockchain. Then it becomes a permanent record. All this happens without the intervention of a bank. That is the specialty of Bitcoin.
One of the most unique features of Bitcoin is that its supply is limited. Bitcoin creator Satoshi Nakamoto has decided that the total number of Bitcoins will be limited to only 21 million. Now the question arises, why was such a limit imposed? The reason for this is the inflation problem in the normal monetary system. Governments can issue new money whenever they want, but Bitcoin cannot do that. The Bitcoin supply is already written into the code. Therefore, many people consider Bitcoin to be a digital scarce asset. That is, a digital asset with a limited quantity. For example, gold has a limited supply, so it has value. Many people also see Bitcoin as such a limited asset.
When talking about Bitcoin, one thing you definitely need to know is Bitcoin halving. Halving is the process of reducing the Bitcoin mining reward by half. Miners on the Bitcoin network receive a Bitcoin reward when they create new blocks. But after every 210,000 blocks, that reward is reduced by 50%. This usually happens about once every 4 years. For example, initially, the reward a miner received was 50 Bitcoin. Then it became 25, then 12.5, then 6.25. Thus, the rate at which new Bitcoins enter the market slows down. Halving events attract a lot of attention for Bitcoin prices because the supply decreases.
Now, let's look at why the price of Bitcoin changes constantly. Bitcoin price is determined mainly by demand and supply. Simply put, if more people want to buy Bitcoin, the price can go up. If more people want to sell, the price can go down. There are several main factors that affect the price of Bitcoin. 1. Demand. The number of people using and buying Bitcoin in the world increases. 2. Supply. The limited amount of Bitcoin. 3. News and market sentiment. Good or bad news affects the price. 4. Institutional investors. Large institutions invest in Bitcoin. 5. Market cycles. There are cycles in the crypto market like bull market and bear market. But there is no guarantee that Bitcoin price will always increase and you will make a profit. It is very important to understand the risks when investing in cryptocurrencies.
Now, let's look at something that a cryptocurrency user should definitely know. That is a crypto wallet. Many people think that a crypto wallet is a digital bag that is used to store Bitcoin or cryptocurrency. But Bitcoin is not actually stored in a wallet. This is a bit surprising. Cryptocurrency is on the blockchain. The wallet contains the keys needed to access your cryptocurrency. Simply put, a crypto wallet is a device that confirms ownership of your digital assets. For example, just like you need a password to log into your bank account, a crypto wallet also requires secure keys. Let's first look at Hot Wallet. A hot wallet is a crypto wallet that is connected to the internet. That is, a wallet that is used on your phone or computer. Examples: mobile wallet apps, browser wallets, desktop wallets. The specialty of hot wallets is that they are very easy to use. You can quickly send and receive cryptocurrency and use services like DeFi. But because they are connected to the internet, more attention needs to be paid to security. Hot wallets are generally more suitable for daily use, for storing small amounts of crypto. Now, let's look at cold wallet. Cold wallet is a method of storing cryptocurrency that is not connected to the internet. This is mostly used by those who hold cryptocurrency for a long time. For example, devices like hardware wallet. The specialty of a cold wallet is that the private key is kept offline. Therefore, it is more secure from online attacks. Many large investors use cold wallet to protect their cryptocurrency. Simply put, hot wallet, easy to use on a daily basis. Cold wallet, better for long-term security. Now, let's look at the public key. A public key is something like the address you use to receive your cryptocurrency. For example, if you want to send someone Bitcoin, you give them your Bitcoin address. That's what the public key is. This can be shared with others, but no one can use your cryptocurrency with it. Finally, let's look at the most important thing, the private key. The private key is the secret code that gives you full control over your cryptocurrency. This is like your digital signature. If someone gets your private key, they can control your crypto assets. So do not share your private key with anyone. The most important thing to remember here, not your keys, not your coins. That is, if you do not have your private key, you do not have full control over your cryptocurrency. Now let's look at another important part of the cryptocurrency world. That is the crypto exchange. Simply put, a crypto exchange is an online platform where you can buy, sell, and exchange cryptocurrency. Just like we go to an exchange office to exchange money in the normal world, in cryptocurrency, we use a crypto exchange. For example, you have Sri Lankan rupees. If you want to buy Bitcoin, you can deposit money and buy Bitcoin through a crypto exchange. A crypto exchange allows you to buy cryptocurrency, sell cryptocurrency, trading, manage your assets. There are a large number of crypto exchanges in the world. Some of the most popular ones are Binance, Bybit, Coinbase, Kraken. Millions of people around the world trade cryptocurrency on these platforms. But you should be careful when choosing an exchange. Things to look for: security, reputation, trading fees, available features, customer support. Since security is very important in crypto, it is important to use a reliable platform. Now, let's look at KYC. KYC is an abbreviation for Know Your Customer. Most crypto exchanges require KYC verification to fully use an account. KYC usually involves your name, identity card information, residence information, face verification, etc. The purpose of this is to prevent fraud, reduce illegal transactions, increase the security of the platform. Now let's look at spot trading, which is a major trading method on crypto exchanges. Spot trading is the way you actually buy a cryptocurrency. Example, imagine you bought a Bitcoin. That Bitcoin is in your wallet. When the Bitcoin price rises, you can sell it and make a profit. In spot trading, you own the actual crypto asset. Usually, leverage is not used. Easy for beginners to understand. Finally, let's look at futures trading. Futures trading is a method of trading based on whether the price of cryptocurrencies will rise or fall. Here, you do not actually own the cryptocurrencies. What you are doing is trying to profit from price changes. In futures trading, things like long position, short position, leverage are used. However, the risk in futures trading is high. Risk management is very important, especially when using leverage. Now, let's look at Bitcoin, the #1 name in the cryptocurrency world. Bitcoin is the world's first successful cryptocurrency.
The main purpose of Bitcoin, which was started by Satoshi Nakamoto in 2009, was to exchange money digitally between people without a bank or central institution. Features of Bitcoin. The supply is limited to 21 million. It works on blockchain technology. It is decentralized. It is used worldwide. Many people consider Bitcoin to be a digital gold. The reason for this is its limited supply and the belief in its ability to maintain long-term value.
Next, let's look at Ethereum. Ethereum was launched in 2015. While Bitcoin's main goal is to create a digital currency, Ethereum's idea is a little different. Ethereum is a platform that can run apps and smart contracts on a blockchain. Simply put, Ethereum is not just a cryptocurrency. It is a system that allows developers to create various applications on the blockchain. On Ethereum, DeFi applications, NFT projects, smart contracts, Web3 applications, things like. Now, let's look at BNB. BNB is a cryptocurrency associated with the Binance ecosystem. Initially, BNB was used to reduce trading fees on the Binance exchange, but later the use of BNB grew significantly. On the BNB chain, decentralized applications, DeFi projects, token projects, things like this are implemented. The value of BNB is linked to the growth of the Binance ecosystem.
Next, let's look at Solana. Solana is a cryptocurrency that is popular as a fast blockchain network. Its main focus is on fast transaction speed, low fees, scalable blockchain. The Solana network also has DeFi, NFT, Web3 projects. Now, let's look at XRP. XRP is mainly focused on fast and low-cost international money transfers. The goal is to use blockchain technology to speed up the process of sending money between traditional banking systems. Finally, let's look at stablecoins. A big problem with cryptocurrencies is that prices fluctuate frequently. That's why stablecoins were created. The purpose of a stablecoin is to keep the price stable. Examples: USDT, USDC. These coins are usually pegged to the US dollar. Stablecoins are very important in crypto trading. Many traders use stablecoins like USDT to buy Bitcoin or other crypto. We have now learned all the basics about cryptocurrency. Now, let's see the end. What will be the future of cryptocurrency? Cryptocurrency is a big change that brings together the current monetary system, technology, and the internet. In the future, digital payments, blockchain technology, and decentralized systems may develop further. But cryptocurrency is still a developing technology. Therefore, when making decisions about the future, we need to pay attention to the opportunities as well as the risks. Another term often associated with cryptocurrency is Web3. Web3 is a new phase of the internet based on blockchain technology. Many of the services we use on the internet today are controlled by large companies. But the idea of Web3 is giving more control to users, providing digital ownership, using decentralized applications. Technologies such as NFT, DeFi, and smart contracts are associated with Web3. DeFi is an abbreviation of the two words decentralized finance, a system that attempts to perform common financial services such as lending, borrowing, trading through blockchain without a bank. The goal of DeFi is to provide open financial services to anyone in the world. But DeFi also has smart contract risks and market risks. Finally, there are a few important things that anyone learning about cryptocurrency should remember. First, get knowledge. Don't invest money without understanding anything. Second, practice risk management. Cryptocurrency has opportunities as well as risks. Third, be careful about security. Protect your password, private key, seed phrase. Finally, remember, cryptocurrency is not a get-rich-quick scheme. It is a technology. The important thing is to understand it, research it, and use it responsibly.
I hope you learned a lot from this video. If you would like to see more videos like this, please leave a comment. Also, don't forget to subscribe to this channel.